That I've found over the years has worked for me. The funds which have been the best performers for me have tended to be the ones with a wide remit.
Go anywhere.
Go anywhere funds. They give the fund manager the broadest possible canvas. So I find that the global funds work best. I find that some of the best fund managers actually end up managing global funds. And just if I look at the performance of my fund picks over the years, the best performers have tended to be global funds.
Hello and welcome back to the Personal Investor Podcast. I'm Ed Monk and I'm joined today by Fidelity's Tom Stevenson to discuss Tom's fund picks for 2026. This is always a hotly anticipated moment when you get to hear the funds Tom is personally picking for the year ahead. Before we get into the picks, let me remind you that if you find this video useful or interesting, to please subscribe to the channel. Give us a like, join the discussion in the comments below. It really does help others find what we're doing here, and it means that you'll get new content as soon as it is released. That all said, Tom, welcome along. How are you?
Very well, thanks, Ed. Thanks for having me back.
Good. Now, before we get into the picks, let's give them their correct framing, shall we? How should people view the picks that you're making today, and how do they sit alongside previous picks that you've made over the years?
Yes, over the years. I mean, I've been doing these fund picks for 10 years now. We started in 2016. I guess the way that we should look at them is they are fund recommendations that sit within the context of the investment outlook that I also write on a regular basis, actually quarterly. Been doing that for about 10 years as well. So there is an element of the here and the now. You know, these are the fund picks that make sense given my thinking about the markets, you know, in the year ahead. But I think we should think about these fund recommendations as being a longer term thing than just that. And you know, there's good reason for that. You know, often with these fund picks, I'm picking them because they're well managed funds. That I think have got, you know, legs, they've got sustainability. They won't necessarily come good in the next 6 months or a year.
Yes.
But, you know, I recently went through the process of looking back over the 10 years of recommendations that I've made. And very often you see that the fund recommendations which I made several years ago actually came good in subsequent years. So, you know, years 3, 4, 5, 6, 7, they did well. So the way I think about them is partly within the context of what's going on in the markets, but more importantly, as long-term, you know, hopefully reliable funds that people can put in their portfolios and hold for the long term.
Yeah, and you tend to make 3 or 4 of these picks each year. So what's that sort of, you know, 30 to 40 funds that you've picked over the years, I should say. Lots of people will follow your recommendations. They're funds that you invest in. We should say that from the start.
Yeah.
They're not personalized financial advice for anybody, but people do follow them, and they will have, you know, built up holdings in many of your picks over the years. And that's okay, isn't it? You know, it should be a sort of a stable of funds that can potentially sit alongside each other, but obviously with, you know, paying attention to all the normal advice, well-balanced portfolio, etc.
Yeah, I mean, a couple of points there. One is it's not a portfolio. I'm not saying that, you know, if you invest all your money in these 3 or 4 funds, then that is a sensible portfolio. It's not. These are just individual ideas. And the other point that you made there is an important one to reiterate, is that this is not personalized advice. I'm not saying that, you know, these funds are going to be right for you as an investor. They're a reflection of what I am doing personally, and I do invest in all the funds that I recommend, and I continue to hold them.
Okay, well, let's get into the first of your picks then, Tom. And this is the Dodge & Cox Worldwide Global Stock Fund. A fund so good, Tom, that you've picked it twice. It was in the picks last year and again this year, so that's a seal of approval. Tell us why you picked it again.
Yes, I mean, I make no apology for that. I mean, I do this occasionally. I mean, they're not new picks every year. So last year, for example, I recommended the Fidelity Global Dividend Fund, and I'd recommended that the previous year as well. So you know, I will sometimes repeat a fund pick. The Dodge & Cox Worldwide Global Stock Fund is, as its name suggests, a global fund. that I've found over the years has worked for me. The funds which have been the best performers for me have tended to be the ones with a wide remit.
Go anywhere.
Go anywhere funds. They give the fund manager the broadest possible canvas or hunting ground, however you want to express it, to find the stocks. So I find that the global funds work best. I find that some of the best fund managers actually end up managing global funds. And just if I look at the performance of my fund picks over the years, the best performers have tended to be global funds. So I'm always quite keen to have a global fund. I think for many investors, myself included, they have this built-in diversification, geographic diversification, which works well.
Lots been said in the past year or two about global funds, particularly global tracking funds that end up with a whole lot of money in the US market and in just a small number of companies within that US market. How does this fund stack up on that score?
Yeah, and that's really one of the main reasons why I've chose this fund both last year and this year. It is a global fund, but it has an explicit underweight to the US market. So the US accounts for about 70% of the value of global stock markets. This fund has got about 50% of its assets in US stocks. And it's also, because it's a value-focused fund rather than a growth-focused fund, it tends to have less in the kinds of stocks which have done very well in recent years. So the big tech stocks, the big growth companies. So I mean, this does actually have Alphabet in its top 10, but I think that's the only one of the Magnificent Seven.
It's got TSC, the Taiwanese,
the chip maker. So it's got some technology, but it's not really Magnificent Seven focused.
No, I was looking at the top 10, as well as those that you mentioned, GlaxoSmithKline. Pharma, sort of good, solid, defensive dividend stock. Defense stocks, some banking as well. So not reliant on sort of the kind of great growth of tech.
No, it's very much a value focused fund. I mean, they sort of describe it as they would rather own a fair company at a good price. So price is really important. Valuation is a key part of the fund selection process. They'd rather do that than own a great company at a fair price. So that's the sort of Buffett approach, of just buying the best and accepting that you have to pay a high price for it. So this is more of a value focused fund. So it's quite different from what has worked well in recent years. Despite that, and despite its relative underweight to the US, it's had a very steady performance. And that, for me, is really attractive, that it's managed to deliver good performance despite its style not being in favour. It suggests that they've got a good disciplined approach and good stock picking capability.
Yes, and it strikes me that a fund like this, actually this applies to maybe all of your picks, they would actually sit quite well alongside something very vanilla because... this alongside a global tracking fund will reduce those big concentrations and those big exposures that some people worry about.
It would also, I think, sit well alongside a more explicitly growth-focused fund.
Right. Yeah.
So, I mean, a fund which I've recommended in the past, the Rathbone Global Opportunities Fund, again, a global fund. It's actually got a US overweight. It's got a growth focus. Put the two together and you get quite a nice balance.
Okay, well, the next choice, Tom, is a familiar name around these parts. It's the Fidelity Special Situations Fund. So why a UK fund, as this is a UK fund, and why this UK fund?
So I think, one of the sort of themes that sort of underpins my investment outlook this year and underpins the fund choices is this sort of movement that we started to see last year out of the US into global markets, which in many cases are much cheaper than the US and also geared to different types of sectors, and that's particularly true of the UK market. So in terms of valuation, the UK market is cheap, and the more domestic side of the UK market, so I'm thinking FTSE 250 as opposed to FTSE 100, is even cheaper still. And one of the attractions of the Fidelity Special Situations Fund is that it invests right across the market cap spectrum.
Yes.
It invests in larger companies and medium-sized companies as well, some smaller. But so I think it's appealing on that front. It's an attractively valued market. But in terms of sectors as well, the UK is we know it's full of pharmaceuticals, banking, mining, kinds of sectors which are very different from the technology growth stocks which have driven markets so far. So if we are getting this slight rotation in markets, which I expect to continue, we've seen it over the last year or so, I expect it to continue, then I think lots of US investors in particular are starting to look at other markets like the UK.
When you look at the sort of analytics of a fund like this, it suggests there's more of a cyclical focus, so that they have companies in there that tend to produce their returns in a cyclical way, perhaps attached more to the sort of natural cycle of the economy. Now, in the UK, we haven't really had much of an upswing economically, but this fund has still found ways to perform, hasn't it?
Yeah, it has. It's a contrarian fund. It's a value-focused fund. It doesn't invest in the sort of obvious mainstream places that many UK funds would invest. So that's one reason why I think it's done well. It's got a long track record actually of performing through different phases of the market cycle, which is for me is an indication that the manager Alex Wright is a good stock picker. So a lot of the value that he's creating is from picking the right stocks rather than being in the right area of the market or the right style. To the cyclical question that you raised there, I think that we are at the beginning of an interest rate cutting cycle in the UK. Now, how far that goes remains to be seen. Depends on the inflation rate. But I think if interest rates start to come down, then those cyclical sectors will start to perform reasonably well.
Okay. Well, finally, Tom, your last pick is the Lazard Emerging Markets Fund. What's the case for that one?
So, you look at what happened last year, the best performing equity asset class was emerging markets. It outpaced even Europe, which did well last year. Emerging markets have really sort of come back. They've had many years of underperformance. I think there's a long-term case for investing in emerging markets. I mean, the demographics of emerging markets, the valuation of emerging markets, the growth in the sort of middle class in places like China and India and South America and South Africa. These are long-term growth stories. But there's also a shorter term sort of tactical reason to invest in emerging markets, and that's to do in part with the US dollar. When the dollar falls, it tends to be a good backdrop for emerging markets, and we saw the dollar falling last year. And I think given the focus on lower interest rates in the US, we've got a new Federal Reserve chairman coming when Jerome Powell steps down in May. I think the expectation is that the new Fed chair will be more amenable to lower interest rates, maybe than Powell has been. So that's going to put downward pressure on the dollar. So I think that's a positive. I think there's a commodity argument for emerging markets. Many emerging markets exposed to commodities. Commodities, I think, there are lots of long-term drivers for commodities at the moment. So I think there are lots of good reasons why you would want to be invested in emerging markets. Why this fund in particular, the Lazard Emerging Markets Fund, it's a very well-established fund managed by an experienced manager, James Donald. He's based in the US, but he invests the world over. Very good track record. Considering how volatile emerging markets can be, it's delivered a very smooth return over the years. So those are the main reasons why I've picked this one.
Okay, well, we've covered absolutely loads there, Tom. So let's leave it for now. I will just remind you all that if you found this useful or interesting, to please subscribe to the channel. It means that you'll get updated content as it is released. Give us a like or share the episodes. It really does help other people find what we're doing here. If you want to read more about Tom's picks for this year and to see how previous picks have performed, you can find that at the Markets and Insights section at fidelity.co.uk. That all said, Tom, thanks for joining me.
Thanks, Ed.